Hey, what is going on, everybody? The housing market continues to surprise to the upside. We've seen existing home sales coming in, beating expectations. They're up 0.8% month on month. This is following a huge surge that we saw in January, coming in at 8.1%. But as you zoom out, you can still see that even with this uptick in pending home sales, we're still down 21% year on year. So the real question is have we found a bottom in the market? And is there enough homebuyer demand to continue to maintain price levels where they are today? We're going to unpack that here in this video. If you're new to the channel, please hit that like button and consider subscribing to see more weekly housing market content just like this. Let's get right to it. Now, as I mentioned, we have seen an uptick in pending home sales, but we're down more than 20% year on year. And this chart here is a really interesting illustration. We are currently sitting at a record level of 9 straight months where we have seen a 20% or more decline in the amount of pending home sales. And you can see here as we go back to where we were in the great financial crisis leading into 2008, the highest level there was about 2 months. So this is an absolutely massive number, and it's a testament to how much the market has really slowed down over the last several months. The recent uptick in pending home sales is actually the highest level that we've seen since August of last year. So the market is starting to move and pick up just a little bit. The number of signings that took place in February actually rose in every single region except for the West, where homes were most expensive. And signings increased by about 6.5% in the Northeast, coming in at the top spot. According to Redfin, the housing markets in tech hubs and pandemic boom towns are cooling the fastest. And this heat map here provided by them is really a good illustration of that. You could see that markets like Seattle, San Francisco, San Jose, Los Angeles, Austin, Texas, and even areas in Florida where homebuyer demand is just falling off a cliff at this point. And of course, most of these are locations where home prices still remain significantly detached from local wages, and a lot of them are tied to the tech industry, which has seen thousands of layoffs over the last several months. And one other thing that I just want to point out is some of these high-flying areas like San Jose, where the median home price is sitting at about 1.25 million. A lot of these tech companies offered stock options to their employees. And when the stock market was really high, the employees were able to exercise these stock options and put a significant amount of money down on their property. And of course, we were dealing with record low mortgage rates about a year ago. So it gave them this really unique opportunity to get involved in the market, but it really drove home prices up. And now we're starting to see the repercussions of that unfold here. As we get further into 2023, it's starting to become more clear that the market is hypersensitive to where mortgage rates are. Some could argue that the recent resurgence we've seen in existing home sales is due to the brief dip that we've seen recently in mortgage rates. This chart here is really a good illustration of that. You have the red line, which is a representation of where mortgage rates are. Keep in mind that this is put in reverse order. As of right now, we're sitting somewhere right around 6.3 to 6.5% with the average 30-year fixed mortgage rate. But you can see that when we were sitting at about 7.5%, this blue line here is an illustration of pending home sales. Pending home sales fell to a record level when mortgage rates were at a record high. And as mortgage rates went down, pending home sales increased. According to this forecast here, they're anticipating where mortgage rates are going to go over the next couple months as we go into April and May. This is just a forecast, but if in fact we do see mortgage rates go back over 7%, we're likely to see the number of pending home sales continue to grind a little bit lower from where we are today. You can see there's actually a relatively strong correlation between the two. And one thing that's super important to keep in mind is that pending home sales is often seen as a leading indicator of existing home sales because homes generally go into contract about a month or two before they're actually sold. So if we see pendings go up, likely over the next month or two, we're going to see the number of existing home sales increase here as well. As we've mentioned in prior videos, there has been a ton of volatility in the mortgage market. And a lot of that volatility is probably coming from the turmoil that we're seeing in the banking industry. But on that news, mortgage rates actually had gone down. We're sitting just under about 6.5% with a conventional loan today. So it's improving affordability slightly. And according to the Mortgage Bankers Association, mortgage applications are actually up. They've rose about 2% for the week. And this is the fourth straight week where these applications have actually risen. And it's just another indication that mortgage rates are really driving a lot of this activity. I think somewhere around 70% of all properties are financed in the United States. So in my view, it's starting to become really clear that if we see mortgage rates go up over 7%, we see home buyer demand completely fall off a cliff and pending home sales basically grind to a halt. Whereas if we see mortgage rates come down to where they're around 6%, maybe slightly under, home buyer demand picks up and comes back into the market. Switching gears slightly, the inflation numbers came out today as well. This is a little bit of macro data that has a lot to do with the overall health and strength of the consumer. Inflation came in just over 6%. That is a little bit off its peak, and we're down slightly from the January number that we saw at 6.41%, but inflation continuing to rise, albeit it's going down slightly. This is going to continue to put further and further pressure on the consumer, making affordability in the housing market even harder. And the unfortunate news is the consumer is still showing signs that they are becoming more and more tapped out. Wells Fargo actually reported that the reliance on credit card debt has actually surged. This is the sixth biggest monthly increase in revolving consumer credit, which mostly covers credit card borrowing, that we've seen in the last 20 years. This is a major problem for the consumer at a time when the rate charged for credit cards has actually spiked to the highest level that we've seen in several decades. We're currently, the average APR on a credit card today is sitting at 19.1%. And a huge portion of that spike came over the last year or so as the Federal Reserve raised their federal funds rate. This is not to say that 15% was much better, but still, paying 19% at a time when credit card debt is increasing rapidly is not a good sign for the consumer, and I think it'll continue to remain a headwind for affordability in the housing market as well. So it's something we're definitely going to have to pay close attention to. And just to recap today's video, we are starting to see mortgage rates fall a little bit, which is bringing home buyer demand back into the market, and we're starting to see existing home sales pick up as well. But if you're zooming out, looking at the macro level, home sales are still down pretty significantly year on year, at a time when the consumer seems to be getting pinched a little bit harder due to inflation, the cost of goods and services rising all around us. So of course, the housing market is facing some major headwinds at the moment. But one thing that I want to make sure that everybody understands is that even though we're looking at this on a national level and we kind of dig into a few separate markets, realize that every single market is different and every segment of the market is different. Even though we may be seeing home prices fall significantly in certain areas in the West, there's other areas and segments of the market, i.e. the first-time home buyer or entry-level home, that are still remaining strong and still in many cases selling with multiple offers. So just make sure that you understand the data and some of these headwinds on a macro level, but when you go to make the purchase on your property, make sure that you're digging into your market at the local level so you understand all the nuance. That is going to wrap it up for today's video. Thank you so much. If you found this interesting, please consider liking, subscribing, and sharing the content, and we will see you on the next video. Take care.